Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Oh, good Friday morning to you, sir. And here we go.
Bob, as we like to do, we'll kick off the show with some listener questions. The first question for you. Bob called for a seasonal run-up in silver and precious metals from December to late January, February timeframe. Does he think the seasonal run is over? What is the near-term 2 to 4 month outlook for silver now they have run up and are starting to pull back? Thanks.
Yeah, good question. We did get a nice rally to overbought on both of them. And it's good at this moment to talk about the ratio between the two, the gold-silver ratio. And it has become kind of volatile over the last few weeks. And we've found, going back a long time, that when the gold-silver ratio number goes up, it begins to signal the possibility of financial trouble. And when the ratio goes down, it suggests a party or financial boom, everything's happy. And as I said, in the last few weeks, it's gone choppy. And in rising, well, first of all, being choppy is saying an alert on the speculative wave that's going on in so many things right now. And the other question is the run over? Well, this is all coming to play. We got the rally in gold and silver, and yes, I think you could say the objectives have been met, and a correction brief is possible. But what I mainly focus on is the gold shares. They've had a great rally, became overbought, and we're into a period of correction here. But this would be within a long bull market for the sector. And I'd also note that the other thing that we've been expecting is that the gold stocks would begin to outperform the S&P, and it has. I did the numbers yesterday, and the gold stocks on the latest rally were up something like 16% or 17%, and the S&P was up something like 13%. No big deal, but it is working that on their rallies, the gold stocks have been outperforming the New York Stock Exchange, which is a good signal, and it's also constructive.
Bob, two more questions. Some in the financial media acknowledge there may be a small 5% correction or so in the coming weeks, and then it's off to the races again with the S&P 500 going up from 35 to 3,800 by year end. Hedge fund managers speaking at this conference said investors should ride the Fed QE4 liquidity train into 2022. I think that the Fed would be a little more nervous right now since the Fed's stealth non-QE has publicly been exposed as real QE at Davos, where all the financial people gather every year, and in the financial media. Bob, where does the Fed go from here?
On the last question, where does the Fed go? It should shut the doors and become a currency board. But the question is appropriate. And it's pointing out that the bulls are thinking that the market will continue to advance overall and liquidity driven. Well, I just happened to stumble across it the other day. Some articles we wrote in August and September of 2007 as that market was peaking, and the yield curve and credit spreads were changing to adversity, in which we noted. But also it was a liquidity-driven bull market, and that it was the Fed that was driving it, and therefore nothing could go wrong. So I think not. The credit spreads they were favorable, and the yield curve was sort of favorable for the last few months. And my colleague Ross Clark, in early October, looked at things and said, "Hey, this stock market thing can rally quite well," and into December, January, which is a period that we used 2 years ago. The same thing, only it was my page that in early October called then in 2017 for a speculative move out to the end of the year, and then noted previous examples, and you had the New York Stock Exchange, I think it was to January the 11th of 1973, and then it was followed by the worst bear market since the 30s. Then moving ahead, you had gold and silver, that crazy speculation. And I think the end of that one was January 20 of 1980, and then the bear market. And then, the Nikkei, the incredible Japanese bubble, and that concluded on the last trading day of 1989. And then, as I said, we played this thing in January 2018, when the stock market then sold off 20%. Also, the phenomenal Bitcoin bubble blew out in the middle of that December. So here we are. Is the market up when it should be? Yeah. Are there signs of speculation? Yeah. And the valuations are at the moon. So I think this could be quite a significant correction. I think a 5%, you'd hardly look at that at all. But thanks very much for the question. Oh, yeah, we talked about the gold-silver ratio. So
yes, and the second question, the gold and silver mining shares seem to be following the equity markets in this runaway buying mania. Bob, shouldn't the precious metals sector and the stock market actually be inversely correlated?
No, that one doesn't work. The inverse is that the gold's real price, as deflated by the consumer price index, goes down in a boom, and then it goes up in the contraction. That's the inverse. But the gold stocks are influenced by what's going on in the big market. But what we're looking for now is the gold sector, to correct, because it became overbought, along with the senior stocks. So a correction there. But again, over the next few years, the gold stocks should outperform the New York Stock Exchange. And as I said, also, even on the last 3 months, the gold stocks have outperformed the S&P or the New York Stock Exchange comp. So, hey, it's working already.
We'll have more with Bob Hoye right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Bob, some of the headlines you spotted today. The first one, foreigners are dumping their bonds in India. They're concerned about their growing deficit.
Yeah, that's where you've had people buying bonds all the way around the world reaching for the yield because the yield on high-grade bonds are so low, and this is an evil that central bankers are forcing upon investors of all classes, and rates have become so low that in order to get a decent return, you got to go to buying risky stuff, which they're doing. So what we're watching for is when that bid for junk, and you might include India sovereign bonds as probably maybe they might end up as junk, and they're beginning to avoid it. So it's a telltale and worth following.
A Harvard professor says the global economy is now entering a sweet spot. What do they mean by that? I thought things were declining right now.
Well, this is a widely followed financial economist at Harvard, Carmen Reinhardt, and they're saying things are absolutely fine. Of course, this was at Davos, so you've got to say positive things. But the sweet spot, it reminds of the statement that you get close to market highs where it used to be Goldilocks, where the economy was not too hot, it was not too cold, it was just right. And I think this is an example of that. It's a sweet spot. And you got to remember that in December of 2007, the stock market had peaked in the middle of October. That was when Greg Menku at Harvard, an Harvard economist, came out and said that nothing could go wrong. And the reason is that because the Federal Reserve had, quote, a dream team of economists who were on top of things, and then you ended up with the worst calamity since the 1930s. And then that also there's examples of everything's in a sweet spot then, and on the way up that boom, you had John Moody, who was formed Moody's, the research group, and he said that nothing could go wrong because the country now had the new and scientific Federal Reserve System. And their theory was that by providing liquidity as a lender of last resort, they would take away the financial crises that preceded recessions. So there'd be no more recessions. And there's been 18 recessions since the Fed opened its doors for business in January 1914. But in reviewing this history of bold figures saying that nothing can go wrong at the top of a boom, there's yet another one, and it has rather good irony because in the boom that blew out in New York in the summer of 1873, there were the usual strange showing in the credit markets, and a New York newspaper editorialized that nothing could go wrong. And the reason is because the U.S. did not have a central bank constrained by gold. It was on fiat money, and the Treasury system was running things, and it could provide an endless amount of liquidity. And then at the same time, in England, the editor of The Economist, Walter Bagehot, he had published a book called Lombard Street, and in that book he was very persuasive in pointing out that when it was needed, the Bank of England would be there to provide the liquidity needed to prevent a contraction. So in England, the senior economy, the boast was that the Bank of England, even though it was on a gold standard, could provide the liquidity. In New York, it was that the benefit was that the U.S. did not have a central bank and could provide unlimited liquidity. Well, in the senior economy in England, the contraction was severe enough that by 1884, senior economists began calling it the Great Depression. And it lasted from 1873 to 1894. That's 1895. So here we are, that at the top of a bubble, the bulls will look at whatever financial agency exists, like quasi-government agency, and conclude that it is there to keep the bubble going, and it doesn't happen. So you've had 1873, 1929, 2007, and here we are. Only this time, instead of using Goldilocks, the economy is in a sweet spot. So I think this is what we call a headline keeper, and we'll watch and see how it all turns out. But what we were looking for is for a speculative thrust to run into around now. So then you have your little checklist. Is the stock market up when it should be? Yes, we were expecting it somewhere in December, January. Are there signs of speculation? Yeah, our indicators are showing tremendous speculation. And then the other one is, are there high valuations? Yeah, there are high valuations. So, and it's all at the right time. So what we've looked at and concluded a couple of weeks ago is, in reviewing the excesses, said the other thing that would be distinctive is when the stock market actually broke down and took out, a previous low kind of thing. And that seems to be happening now. I thought maybe the transition from up to the breakdown maybe have been more prolonged, but hey, it seems to be working out now. And also, you're getting a hit in crude oil prices and base metal prices. The yield curve is, it's not moving negative or positive, but the credit spreads, the difference between high grade and low grade bonds, are again starting to move to widening. So there's enough things going on right now it looks, Jim, like the correction has started, and we'll just see how far it goes.
We'll have more with Bob Hoye right after the break.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, another headline you spotted. Bridgewater says it's the end of the boom and bust cycle. Does that mean everything's going to be sunny and rosy forever?
That's another way of saying it, Jim. And this, again, was a quote from an interview of the co-chief investment officer at Bridgewater. Bridgewater is huge. And this was done in Davos. And this is what he was saying, that the argument was that the Fed had already lowered interest rates and there was no need to lower anymore. And then there was no reason to raise interest rates. So therefore, and then his lead into that was that changes in Fed policy caused the boom-bust cycle. And we've shown that the financial markets lead the changes by the Fed at the top of a boom by about 4 or 5 months. So, no, it's conventional research and he should be doing more in-depth research. But again, it is that things are fine, and the boom-bust cycle has been ended. And how many times have you seen that? And as I said, let's say it once again, Jim, that since the formation of the Fed, which promotion included the notion that they would eliminate the recessions, there's been 18 recessions since then. So central banking, as they celebrated, just doesn't work. And history shows that it doesn't work. But again, it'll be fascinating to see how the next few months go and how far this correction goes.
Bridgewater, isn't that the company that Anthony Scaramucci works for?
Oh, I'm not sure on that one, but Bridgewater is huge, and it's very difficult to manage money, and it's also, the bigger you get, the more difficult it is. But nonetheless, this was a statement I take as trying to keep everybody bullish, because here you are, you got such a big fund, you can't get out anyways. So we'll see what happens.
Well, whenever the economy gets into trouble, or the stock market, which people confuse for the economy, the central banks lower interest rates. However, Alan Mark Angel, noted West Vancouver realtor who's sold over 4,000 properties, was telling me it's nearly impossible to get a high-end mortgage. You almost have to have as much collateral as the mortgage, so you might as well finance yourself. So it doesn't help if the banks lower interest rate, or the central banks lower interest rates, if the real banks aren't willing to lend out that money.
That's a very good point. The other one is that if you're insolvent, the level of interest rates, it really doesn't matter. But the other one we'd point out is that there's 400 years of evidence that on a boom, in short-dated market rates of interest go up, and on the bust they go down. And then on the conclusion of the great bubbles since the one in 1825, I've pointed out that the market rates of interest, such as a T-bill rate, which trades all of the time, that it leads the Federal Reserve. So the thing to get out of your mind is that the Federal Reserve has control over financial affairs. That's a myth. It's the market forces that do it, and it's ironical, but I'm going to say it, is that in a decade, like up to 2008, the public chose to speculate in tangible assets, such as commodities, and crude oil soared up to $147. And then the commodities get hit, and their day in the sunshine is over, and then the public shifts over to speculating in financial assets such as stocks and bonds. And here's another case where this was the change in 1920, which was the end of the big commodity boom, and then they just shifted over to speculating in the stock market, and the Federal Reserve was looking at weak commodities and was concerned. So it was easier than it might have been if it had understood about financial bubbles. So the Fed was easing money in a financial bubble, and then that crashed. So then we move ahead to the period with the Obama administration, when the economy really wasn't doing very well, and the central bank got all concerned that they had to have inflation up to 2%, otherwise something bad would happen. So they were looking at weak pricing power, and what were they doing? Injecting liquidity into a bubble in financial assets. So the Fed did the same thing recently as it did in the 1920s, and we have huge speculation going on in financial assets, and at some time it gets over. And again, this is the public's choice. It is the public's choice to speculate in stocks and bonds. And they will speculate until it goes too far, and then the speculation exhausts itself, and then you have the contraction. And who knows, but maybe this one could do it. And the Fed Reserve and previously the Bank of England, you can show them historically that they are just along for the ride. The financial markets are doing their thing, and the public sets the game, and the public chooses when to go broke with the assistance of margin clerks. So, and this is why you get the contractions, because margin clerks have much more power than do central bankers. And if the central bankers had the power, there'd be no bear markets and no recessions. But, as I said, you've had 18 recessions since the Federal Reserve started business. And it's a very strong argument against the notions of intrusive central banking. And there we are. I'm using big words again, so it's time to take a rest.
Thank you so much, Bob.
Hey, Jim. Always good to be with you, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.